Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Polaris Inc. stock, ticker PII. This one came in by request down in the comments of one of my other videos. If you have a request of a stock you'd like me to take a look at on the channel, put it down in the comments. I will make a video for you eventually, and I'll post it either here or on the free tier over on Patreon. Finally erased a couple of the columns of tickers back here on the chalkboard, so I've made a little bit of progress the past couple weeks. As always, this is not individual investing advice. This is just how I analyze stocks. Okay, so the first thing, let's look at what they do first. I think I pulled up a description from good old Chat GPT. All right, this is going to be printed small, so I'll read some of it. American company based in Minnesota. They design, sell, manufacture power sports vehicles and related products. Okay, so off-road vehicles. So think like four-wheelers, side-by-sides, things like that. Snowmobiles. It looks like they have Indian motorcycles too. One of the reasons I looked up the description is because I didn't know all their brands. So that's a competitor to like a Harley Davidson. And then it looks like they have some pontoon boats that they make as well. And then some smaller markets and things that go along with that. But mostly I would think of them as like a four-wheeler and snowmobile manufacturer. So with any kind of recreational vehicle, almost any kind of vehicle really, they're almost always going to be cyclical. That's usually the first thing we check. Let's go back and look actually. Now, the last big down cycle we had is almost more than 20 years ago, until recently. So it's a little tricky to go back and judge whether it's, cyclical or not. Now, whenever something's like they say leisure products, that could be a lot of things. But whenever somebody's in like manufacturing business, there's almost always a certain amount of fixed overhead costs. So when you have a pullback in demand, a lot of those fixed costs can stay pretty high. That's what creates the extra cyclicality compared to like a normal, less cyclical business, right? So I would assume from the start that would be the situation here. Now, when we look at just the adjusted earnings, they have had a decline, it looks like in 2006, okay? That was kind of the beginning of the housing decline, deterioration leading into the Great Recession. And then in 2009, another 13% decline. Those aren't very big, so I want to look at the basic earnings here and see if there's a difference. Not much difference, okay? So now, I don't know how high these earnings were in 2004 and before that. But since I would assume ahead of time that they're probably cyclical, even though the evidence here doesn't necessarily point to that, it could be that they had a big upcycle in the early 2000, the late 90s, and all of this is still part of that down cycle. It's potential. So I would be careful in that regard. And one way I can check that is if we look at the stock price instead of the earnings, we can see that it was down. If you don't count dividends, it was down about 80%. So if a business, if the earnings aren't very cyclical, but the stock price falls 80% and it doesn't fall from like extremely overvalued level, like this is only a 23 PE, that kind of tells me that the market is treating it like it's deeply cyclical, whether the earnings show it or not. Now, like I said, if I had more data going back to like 2000, it's possible the earnings fell a lot before this and they just never quite recovered. So they're kind of still in the recovery mode here. And then once we got out of the immediate aftermath of the Great Recession, then you see things start to take off. Probably they acquired, I saw there was some expansion around 2010, probably has to do with this stock split here. So I think they were doing some acquisitions that probably helped earnings growth during this time period too. Now, what we have in 2016, however, is basically a 50% drawdown in earnings. That does qualify as a deep cyclical. And so let's see what this immediate drawdown was. 50 maybe? Yeah, about 50%. That might not have been quite at the peak. And it wasn't quite at the trough either. So we have the stock price falling about the same as earnings. We see some potential cyclicality issues, unless there's like a one-time kind of business issue here, which is possible too. Now, kind of knowing the industry, seeing the stock price fluctuation being so deep, and then we also see this here. So this was during the peak of the industrial kind of cycle, which didn't truly bottom until 2020, as we can see here. So again, we have basically a 65% decline off that cycle. A lot of other industrial and cyclical businesses fell. Well, they fell a lot even in 2018. But the reason that it recovered from that's almost a 50% decline. The reason it recovered a little bit that year was because interest rates were lowered. So I think one of the key things to keep in mind is this is going to be, I think, an interest rate sensitive business, and that's going to come into play now. Okay. So what happened back here in 2009? Well, interest rates were at zero from there till like 2015. And what happens? The stock price has like a 10 bagger or something. Yeah. And I didn't pick the bottom. If I would have picked the bottom, I think you would have had 1,000% return probably. There we go. 2,000%. Holy cow. So, and then as interest rates got raised, especially when they got raised in 2018, we saw that decline. I want to say maybe 2015 is when we first got off zero in interest rates. So to me, I think maybe the interest rates are the big story here, because people are going to often borrow to buy these recreational vehicles. Unless you own a farm or a ranch or something like that, they're mostly going to be discretionary. And so that all makes a lot of sense, right? So that brings us into today. Now, if we zoom out and just look at the stock price, let's get rid of this for a second. It looks interesting. I think it's really interesting down here. We're at $38 a share. I don't even know if it got that low in March. Probably not quite, is my guess. So let me shorten this and see. Yeah, we're actually right at those lows in 2020. So, and it looks like it probably bounced off. It went lower actually, and then now it's just started to bounce a little bit. So that kind of makes it interesting. We kind of have this level here that might try to put a floor in just from a technical perspective. But if we go back to the last time it was that low, we have to go back 15 years. Okay, to just coming out of the Great Recession. And we've had inflation since then. So really it's priced more like in 2010 dollars, maybe more like $20 or $25 a share. So the market's definitely really negative on this. We've seen that if you do buy it at the bottom of one of these downturns, you can do extraordinarily well. So I do think it's interesting in that way. So what's the holdup for me then? Now I've had people ask me about this stock for a long time, all the way down. I don't actually track it like regularly in my spreadsheet for some reason, but I might start keeping an eye on it. I figure usually somebody will ask me about it if it starts looking really good, like it potentially looks now. So we have a worse earnings decline than we've had before. We know that these are probably tied a lot to interest rates, which have gone up a lot. And I think we're probably in a shift where interest rates are going to be staying higher. And so this is the tricky part about this. Let's see here. CNBC. So I just wanted to show you the 10-year yield, which is 4.5% right now and rising. We got a glimpse at the tax bill that's coming out potentially someday. And the bond market decided it's probably going to be inflationary down the road at some point, if not immediately. And so so we had the tariff reprieve to a degree. And the natural reaction, one would think, would be for bond yields to go down. But instead, it looked like what people did was take money out of the bond market, put it in the stock market. That raised the interest rates. And then we got kind of the tax look through a little bit. And then the bond market didn't really like that very much either. So now we have higher interest rates that could go higher. Inflation's still over the target, over the Fed's target, and then we're going to have a lot of mixed signals coming. So I generally think most of the policy changes that we've had are inflationary, and it's just a matter of when we get the data, how it all shakes out, when there's a lot of moving parts, but when you take each one individually, like 9 out of 10 are inflationary. So, maybe only lower oil prices is eventually. Now, if you take core inflation, they don't count that anyway, but eventually lower oil prices will work its way into the economy. So that would be deflationary. But at any rate, rates are a problem. Like you have to really think about that when you're thinking about buying this company. And it doesn't look, the administration's trying to get those rates down and they're not doing a good job. We just went through a whole fiasco where I think their goal was to get the rates down, and they're back up to where they were when they capitulated on the Liberation Day, like 3 days later or something like that. So basically that's what the bond market, what the rates went up to when they kind of threw in the towel, at least temporarily. So rates are still a problem, and for a company like Polaris. So that's a thing to consider. Now, one thing before jumping in at this price, because it does look really tempting for somebody who's a cyclical investor like me. Like, this is what it looks like when I'm usually buying. So it's going to be a longer video than normal. So one thing I noticed when I was looking at these drawdowns is there's a significant difference, especially if I go back farther in time, between how far it fell on a price basis and then how far, this was only like a year's decline, so it wasn't that huge of a difference, but how far it was on a total return basis. And I was like, well, that's a pretty big difference for only a couple of years. They must pay some kind of dividend. I don't normally even look at dividends. That might be one of the reasons. A lot of time I'll get asked on high dividend stocks because people see the dividend first. So this dividend yield, it says it's 7%, basically. I can pull it up. Whoops. Not the right one I want. I want the yellow line. Okay. So dividend yield here, it says 2.4, 4.58. And then that was probably at the beginning of the year and it's kept falling. So if this is right, that's a very high yield. Now, what can happen is, if you can get one of these right and they don't cut the dividend, then you can do really well. I've only seen it happen with a couple stocks. Valero is one. If you would have bought it with an 8% yield in November 2020, you could still be collecting a lot of dividends and capital gains. But it's risky. So if I really think that probably the best buying opportunity is going to come if they cut the dividend. So that's when I would really probably take a chance on the stock. If it didn't look like they were going bankrupt or something. Their total enterprise value is about double their market cap right now. So they have some debt. And if we get into a situation where they need to make some decisions about paying out this dividend, or making sure if we have a recession, which rates are still pretty high and relative to what they have been, probably a lot of demand was also pulled forward during the COVID stimulus. We could get in a situation where they decide that, look, they need to cut the dividend and be conservative and try to make sure they can get through this storm and come out the other side. That will probably send the stock price down quite a bit. That's usually what happens. And that's when I think the risk reward would probably be good enough for me to take a stab at it. The other potential is interest rates come down. It looks like they're going to stay down, which would actually probably also happen about the same time, if there's a recession. And if that happened, and then it looked like, the stock was kind of leading, it looked like earnings were going to recover and the stock price looked like it was recovering, and I still had a bunch of cash, at that point, some of the risk may be mitigated and I might take a little piece then. Because let's say it just goes back to, I don't know, here, right? That's a double, right? So it's low enough you could get 100% return. And I wasn't picking like one of these peaks. Just getting back to one of these previous kind of trough areas, that could happen pretty quickly. So it really, I mean, if a person really liked the business and they think that we're not going to have a recession, now would be a time to probably at least take a small position. I'm kind of leaning the other way, so I want to wait for, which means I could miss out on it, but I'm not quite convinced interest rates are going to come down without a recession of some sort. So I think I'd rather wait for that next leg down before nibbling on this one a little bit. So if they cut their dividend, if you watch this, leave me a comment and I'll revisit it, since I'm not actively tracking it right now. And maybe I'll make an update video and let you know whether I decide to buy it or not. I made another video on a stock like that. I want to say it was Whirlpool, maybe. Can't remember for sure. There's been a couple of them where I've said if they cut the dividend, and then I know at least one of them did, and I still decided not to buy it. So it'll be a game time decision at that point, but I think that would potentially tip me over to the edge. All right, everybody, thanks for watching. If you enjoyed this video, found it useful, hit like and subscribe. I have a $25 a month weekly picks over on Patreon, and those have been doing really well. So, and we have a couple deep cyclicals that are doing really great from the weekly picks. And I'll see everybody later.